Welcome back to Talk Tickers. Today, we are diving deep into the third quarter earnings for the one group. That's ticker STKS. Now, the headline numbers told a pretty tough story. And you know what? The market delivered a swift and very clear verdict. So let's break down exactly what happened and what it all means for the stock going forward. Okay, let's just jump right in with the number that really set the tone for everything. The consensus on the street was for an adjusted loss of 19 cents per share. What did STKS actually deliver? A loss of 66 cents. That's not just a miss. That is a massive chasm, and it put management on the back foot for the entire earnings call. So here's our game plan for today. First, we'll go through the ugly results in a quarter to forget. Then, we're going to unpack management's turnaround playbook. After that, we'll put their full-year guidance under the microscope. We'll follow that up with the market's harsh verdict, and then we'll wrap it all up with our take. That's our official rating and forecast for the stock. Right, so just how bad was this quarter really? Let's get into the key metrics and see how this whole picture of broad-based weakness comes together. Now, what's really telling about this slide is that the pain was, it was everywhere. This wasn't just one bad metric. Revenue came in at about $180 million, a full $11 million below what everyone was expecting. We already talked about that huge miss on adjusted EPS. And then, the cherry on top, consolidated comparable sales dropped by a really steep 5.9%. Ouch. But if you thought that adjusted number was bad, hold on. The official GAAP loss was even more of a shocker. It came in at a loss of $2.75 per share. A number like that really makes you stop and ask, what on earth is going on here? Okay, but here's the crucial context you absolutely have to understand. About $2.20 of that huge loss wasn't actual cash flying out the door. It came from non-cash accounting charges, stuff like writing down the value of struggling grill locations and making adjustments to tax assets. So, yeah, the headline number is really ugly, but it's not a perfect reflection of the company's day-to-day cash performance. So, in the face of these results, management didn't just sit there and dwell on the past. They came out and laid out this multi-pronged strategy. It's designed to completely reshape the company's future and, let's be honest, convince investors they actually have a handle on the situation. Their whole plan really boils down to three core pillars. First, fix or just convert the grill confects that aren't working. Second, put the foot on the gas and aggressively grow the Benihana brand, which is a winner. And third, they're going to leverage their digital platforms and their huge loyalty program to get people coming back again and again. And this slide shows you where the rubber meets the road. They're talking about converting up to 9 grill locations into the higher return STK or Benihana brands. They're pushing Benihana expansion through franchising, which lets them grow without spending a ton of their own capital. And they want to tap into their 6.5 million member loyalty program. It's a really clear pivot. Stop pouring money into what's broken and double down on what's working. Now, this is where the story gets really, really interesting. Despite that massive Q3 miss, despite all the pressures from the outside, management stood their ground. They maintained their full-year guidance, which is basically them betting big on a super strong finish to the year. And let's look at those targets. They are still guiding to almost $100 million in adjusted EBITDA and a full-year comp sales decline of only 2 to 3%. To hit these numbers after the Q3 they just had, they need an absolutely massive rebound in the fourth quarter, all driven by the holiday season. It's a very ambitious forecast. And this confidence was summed up perfectly by the CEO, Manny Hilario, on the call. He acknowledged, yeah, things are tough, but he really stressed that from where they're sitting, the company's long-term strategic future still looks strong. So management might see a bright future, but the market heard the same results, heard the same outlook, and came to a very different and much more immediate conclusion. This slide just lays the conflict out perfectly, doesn't it? On one hand, you have management projecting confidence. On the other, you have investors who dumped the stock, sending it down over 10%. You have an activist investor, Randian Capital, turning up the heat and now demanding they spin off Benihana in an IPO. And the sell-side analysts? They just double down on their strong sell ratings. It's a total disconnect. And you have to understand, this wasn't just a one-day blip after earnings. As you can see here, over the past year, STKS has underperformed its own restaurant sector and the broader S&P 500 by just a massive margin. The market skepticism has been building for quite some time. All right, so let's put this all together. The weak quarter, the grand turnaround plan, the market's brutal reaction. Here is our official take on what comes next for STKS. We are initiating our coverage with an underperform rating. From our point of view, the combination of some serious near-term risk in pulling off their turnaround, plus the ongoing pressure on their balance sheet, well, it just warrants a lot of caution right now. We just see a really tough path ahead. I mean, Q4 should be better just because of the holidays, but hitting that full-year guidance, that's going to be a stretch. The stock is probably going to be a show-me story for a while. Investors will want to see real results before they buy in. The biggest risk here is the company's high leverage. We're talking roughly 7 times net debt to EBITDA. That is a ton of debt, and it leaves basically zero room for error. And the wild card in all of this? That activist pressure could absolutely force management's hand on a big move, like that Benihana IPO, way sooner than they might want. And of course, we always have to leave you with a final reminder to do your own research. This is not financial advice.